We got durable goods out this morning, and the numbers are better than anticipated. 2.6% gain for overall durable goods. That's after 1.3% the month before. In terms of ex-transportation, up just 0.2. There's a big Boeing effect in there because Boeing sold 113 airplanes in March, took orders for, and only 15 in February. So a big change we know coming from the Boeing orders department. Capital goods orders, non-defense, ex-air, this is the part that feeds into GDP, up 0.2 after a downwardly revised 0.4 gain last month, and shipments for March up 0.2 after a 0.6 decline the month before. That's a bit of good news for the economy, but the thing overall that has been bothering some economists is that we have seen capital goods orders running behind shipments for the last year, and that suggests that maybe we are going to see a decline in overall business spending at some point. Last time we got GDP, and we get GDP tomorrow for the first quarter, but for the fourth quarter, it was the second month in a row that equipment spending was down. So that's why durable goods matter, even though they're tremendously volatile. They give us a picture of maybe what's coming.
So this data, Mike, preliminary read on the month of March, so that wraps up Q1. Based on what we understand about the first quarter, have we got a decent read on what we're going to see tomorrow morning?
Well, you got somewhere in a range. The Bloomberg consensus forecast of economists that we've surveyed is 2.5%, which is still stronger than the 1.8 to 2% that the Fed thinks is the sort of neutral growth rate. And the Atlanta Fed GDP, now they'll probably incorporate some numbers from durable goods in there, is 2.9%. So we could see a stronger the lean is to a stronger growth number tomorrow. In any case, it's kind of hard to see how the economy could get a whole lot better at this point, and it's hard to see why the Fed might, well, we'll know Friday when we get the PCE inflation numbers, why they might want to be cutting rates now. They can wait.
Well, this is what Mike Schumacher of Wells Fargo is saying, that he thinks the bar has actually gotten higher with respect to cutting rates just simply because of how hot the data has been or just how strong the U.S. economy seems to be. Do you have a sense, based on some of the rhetoric we heard, not this week because it is the quiet period, but in previous weeks, about how much they have kind of shifted the sense of how many weak prints they need before they can have the conviction to cut?
Well, I think the weak prints would be a totally different story from an inflation print data that they're looking at. Weak prints, they would need a couple of months at least of rising unemployment, significantly rising unemployment. We go back to the SOM rule. Do we see it go shooting up? For inflation, they're going to want 2 or 3 months now because we've had 3 months of inflation going the wrong way. So I think right now, the earliest you could possibly see, unless there's some big surprise in the next 2 days, is July. But the September-November time range for the Fed is probably the most realistic if we get the economy, as they put it, developing as expected.